Understanding quantitative easing, origins and monetary implications, 3/5. Implications of quantitative easing. Impact on the economy. Influence on inflation and deflation dynamics. Quantitative easing, QE, has a direct impact on inflation and deflation dynamics within an economy. By injecting new money into the financial system through asset purchases, central banks aim to increase spending and investment, which can potentially lead to rising demand for goods and services. This increased demand, if not matched by an equivalent increase in supply, can put upward pressure on prices, contributing to inflation. QE is particularly deployed during deflationary periods to counter the risk of falling prices, which could discourage spending and investment. However, the effectiveness of QE in directly causing inflation depends on various factors, including the velocity of money circulation and the overall health of the economy. Effects on employment and wage growth. QE's impact on employment and wage growth is mediated through its influence on economic growth and demand. As QE aims to stimulate economic activity, including consumer spending and business investments, it can contribute to job creation and lower unemployment rates. The increased economic activity resulting from QE can lead to higher demand for labor, positively impacting employment levels. Additionally, a growing economy may exert upward pressure on wages as businesses compete for a limited pool of available workers. Evaluation of the effectiveness of QE measures. Evaluating the effectiveness of QE measures is a critical aspect of understanding their implications. Central banks and economists assess the success of QE programs by considering various economic indicators, including GDP growth, inflation rates, employment levels, and financial market stability. Success is typically measured against the central bank's objectives, such as achieving a target inflation rate or promoting sustainable economic growth. The evaluation process also involves analyzing the magnitude of the impact of QE on these indicators and comparing it with the resources deployed. This assessment helps central banks refine their strategies and adjust their policy tools as needed. Financial market reactions and consequences. Stock market performance and investor sentiment. QE can have significant effects on financial markets, particularly the stock market. The increased liquidity injected into the financial system can lead to lower borrowing costs and higher demand for riskier assets like stocks. This can contribute to stock market rallies and higher equity prices. Additionally, QE's goal of lowering long-term interest rates can prompt investors to seek higher returns in the stock market, further boosting stock prices. However, this positive correlation between QE and stock market performance also raises concerns about potential market bubbles and the sustainability of these gains. Bond market dynamics and interest rate movements. QE programs impact bond markets by increasing demand for government bonds and other assets. As central banks purchase these securities, their prices rise, leading to lower yields. This inversely affects interest rates, as bond yields and prices move in opposite directions. While QE aims to lower long-term interest rates to stimulate borrowing and investment, it can result in ultra-low or negative interest rates, posing challenges for investors seeking yield. Additionally, the reduction in bond yields can influence borrowing costs for governments and corporations. Effects on foreign exchange rates and international trade. QE's influence on currency exchange rates is a significant consideration, especially for economies with open trade relationships. As a central bank increases the money supply through QE, the currency may weaken relative to others due to the increased supply. A weaker currency can enhance export competitiveness but may also lead to higher import costs and potential inflationary pressures. Exchange rate movements resulting from QE can impact trade balances and influence international economic relationships. Understanding the implications of quantitative easing is crucial for policymakers, investors, and the public at large. While QE aims to stimulate economic growth and stability, its effects are complex and interconnected, leading to a range of consequences that extend beyond traditional economic indicators. Financial market volatility. While QE aims to stabilize financial markets, it can also introduce volatility. Market participants closely monitor central bank actions and policy statements related to QE, and any perceived deviations from expectations can lead to market turbulence. Sudden shifts in QE policies or their expected duration can trigger abrupt market reactions, affecting investor confidence and asset prices. As markets become increasingly sensitive to central bank decisions, QE-related announcements can lead to rapid price fluctuations and increased uncertainty. Asset price distortions. QE's infusion of liquidity into the financial system can lead to asset price distortions. The search for higher returns and the abundance of liquidity can drive up prices for various assets, including real estate, stocks, and high-yield bonds. This can create challenges for investors seeking value and sustainable returns, potentially leading to the overvaluation of certain assets. Policymakers must carefully monitor these distortions and assess potential risks to financial stability.